Well, thank you both for joining me. I appreciate your time today, and thank you all for being here. I think the most important thing we should start with here, as you just heard from the Secretary of Energy, I want to talk about what stuck out to both of you, and we should probably go right to the 7 million barrels. Go ahead, Dan.
Yeah, I'll start. 7 million barrels a day, half the gap, as Chris described it. It's a bigger number than I think people had been expecting, and in a way helps sort of justify, if you will, prices that have been maybe a little bit lower than people thought they might with a 15 million barrel a day supply outage. So the fact that that's been happening, one of the questions, of course, we'll talk about is, can that continue? But you know, the world's finding ways to get around these bottlenecks, and that's fairly impressive, I think.
Rebecca?
Yeah, so I think the 7 million barrel number is definitely higher than the street has been kind of pricing in, which has been closer to 3 to 4 million barrels of kind of flows through. So very significant. But I think the other thing that stood out, Julie, is just how resilient this market has been in the face of this conflict. Whether it's more ships getting out, the rerouting, but significantly the change in Chinese imports and how quickly they've been able to reduce their consumption, whether it's rationing, switching. They've really adapted to this environment. And I think that's brought up an interesting question when you look at the strip right now in the mid-70s in 2027 as supply comes back, but also how long lasting are some of these shifts we're seeing in terms of demand and the market resilience when we come out of this. So I think the narrative has shifted a little bit from how many barrels are we missing, where are tank bottoms, to wow, how much demand is going to come back? What does this mean for kind of the market moving forward? So I thought that was an interesting comment he made about China as well.
Anne-Marie also said to the secretary, you know, it's been about 40 times that the president has said that this is over or close to over. At the beginning of this conflict, you really saw the market react when there was something said like that. Is this still affecting the market at this point?
Yes, it is. It shouldn't. I try to look away. I want to look away, but it's too important. If there is a solution here, it does matter, and so everybody's trying to game it. We don't know if there's a deal or not. How many barrels are getting through the strait? That's the important thing, and what we just heard is it's more than we expected. So, you know, that's what we have to keep our eye on. A deal needs to have two sides that agree on what's going to happen, and you've got to be able to trust that. And when that occurs, you got some shot at normalcy, but I think normalcy is going to be higher. The strip's 2027 strips, $15 a barrel higher than it was pre-conflict. Appropriately so, I think.
Rebecca, the secretary did talk about, in that vein, how there is negotiation when there are discussions about this conflict ending.
Yeah, I think the whole concept of the market is reacting and the headlines do matter. They clearly do still matter. But what I would note from a market's perspective, just to be the voice of the market, they seem to matter less and less on an intraday. We used to 5%, 10% moves, right? We saw 2-3% move here. I think what matters more is how many ships are getting through. And it's been leaked over the past couple of days that these numbers are increasing. And I think that's been part of the pressure. None of us can look away, clearly. But I actually think in terms of how the market's reaction, they're more looking at the data, I would say, in terms of what's coming through and looking out again to 27 and what this means for the strip. It's almost like we're getting a little bit numbed to the noise, not entirely. Obviously, the headline's still very much influencing some of the trading action, but there is a fatigue and numbness. And I think there's a reluctance, just again, to come back to the markets, to necessarily be the person who buys this first dip. But I want to wait and see how this really shakes out before I re-engage with the market. And you have seen open interest kind of fall throughout the course of this conflict, and I think it's reflective of that.
Talking about numb to the noise, we heard again today, very emphatically, no export ban. Dan?
Important. That's really important, because if you step in, intervene in the markets, the risk of the market that had been the most important incremental supplier, the U.S. to the rest of the world, you turn that off And then you wind up with terrible signals to the U.S. producers. Secretary Wright said, we want to be an energy superpower. You're not going to do that by restricting flows. And the other piece of that is you then cut off supplies to the rest of the world, and you might wind up with a very, bifurcated market that does sort of no one any good. And so I continue to be relieved that that is off the table, because it would be a terrible signal to the market.
Rebecca, anything else that really struck you today when you heard the Secretary of Energy?
Well, just to continue on this point of the no export ban, I think that's been a huge conversation amongst the kind of U.S. investor base. And there's been a shift of not wanting to be long WTI, maybe having more comfort in owning Brent, the more international kind of standard. But I'd say this, when Anne-Marie asked him, okay, what other levers are you discussing if no export ban is kind of not on the table? There was the ethanol blending, obviously meaningful. He referenced the Jones Act likely gets extended, but we are getting to this point, I think, where the levers get a little more difficult to pull. And I was like, okay, I didn't hear a lot. We're discussing a lot of things, creative ideas, but I think when we look at the levers that have been pulled so far, we're getting to a really tough place where there's not many left. And the export ban is going to remain a topic, even as he says it's not going to happen. Investors are going to worry about it. If you see $5 gasoline in this country on average, that conversation is going to reinvigorate. And I know a lot of investors say, hey, even if he says they're not going to do it, if we get there, it might resurface.
Dan, when the war began, there's concerns about $100, $200 barrels. We're sitting here today, we're looking at about 80. So what happened there?
Yeah, the uncertainty of how much offline for how long was at its peak, if you will, and the ability of the markets to find ways around, whether that's East-West pipeline. I think you saw those workarounds. I think importantly, peace also broke out a little bit, right? We moved from kinetic conflict to a ceasefire, and once that ceasefire started, folks said, this is on a track toward more barrels. And so the fear factor started to ebb, and you took that option premium down, I think, in the crude markets. By the way, that may be temporary. If we don't get a deal, if the Strait does not open, even if 7 million barrels a day get out, that means 7 million barrels a day aren't. And you're going to have to eventually, you're going to reach minimum inventory levels, you're going to start turning off demand, and you're not going to do that at 80 or 90. It's going to be something much higher, like we saw at the beginning of the process. So the answer is we found lots of workarounds. We're drawing down on inventories. We're pulling groceries out of the pantry, but we're not putting any back in. And so if this keeps going, we'll be talking about higher prices again. That's why the deal is going to be important. That's why we have to pay attention.
Rebecca?
So I think that's an interesting point. What we've done is we've extended the timeline of where we hit inventory kind of tank bottoms that everyone talked about. When this initially happened, those conversations were tank bottoms come in mid-May. Okay, China reduced imports. We had more of a workaround with East-West pipe. Now we've got more barrels through. So now we're talking about maybe August. And that's the new estimate out there given these numbers, maybe September where tank bottoms is. So we keep pushing that timeline out. But what's interesting about that concept is the longer you push that out in the midst of a conflict, you kind of should be thinking about it lifting more of the back end of the curve, right? Because we're going to be deeper into this and it's going to take more time to refill those inventories and bring the market back. So we didn't get the spike to 150, 200, and in a way that's made this conflict even more bullish for the longer end of the curve. Because if you'd had the spike and you'd had the readjustment and the barrels and we had a resolution, you would have kind of out of the stasis point where we fight and we negotiate and we fight. But the longer this goes on, I actually think it's more bullish for the curve in the long end.
Let's shift a little here to the short and the long-term effects of what we're seeing. Dan, I want to start with you with the short-term effects of what we've seen the past few months.
Yeah, so the irony is that I think the short-term effects are gasoline prices went up. Everybody paid attention for a period of time to what was going on in the oil markets. And then, unfortunately, I think it's like, we got this taken care of. Bombs aren't falling. This process is going to be over. And we've also had this sort of back and forth deal, no deal sort of dynamic. So I think in the near term, there has been kind of a creation of a bit of numbness. I can't pay too much attention to this because, one, it's not showing up in the market. And I think that's very important. 30% of the market's focused on SpaceX IPO today, not whether or not we have a deal with Iran. So it's basically created a situation where higher near-term prices have been dulled, and now folks are on to other things. I think, unfortunately, the longer term's more interesting, which I think you're going to ask Rebecca about.
I am going to ask Rebecca, but what you hit on that brings us to the longer term is 40% today are on the SpaceX IPO. If there's not a deal, there might be discussion of a deal on Monday. So what's the long-term effect?
Well, just to come back to Dan's point, when I was sitting in the audience listening to Chris Wright, I looked to either side of me at people looking at their phones, and they had SpaceX pulled up. I was looking at crude oil myself.
I know.
We're not scolding you if you weren't paying full attention.
But the two people beside me were looking at SpaceX. So, so clearly the short term, the market's focus has shifted. Diplomacy is the route we're on. That's what I'm focused on. Long term, as I think I've said a couple of times, I think it's the more interesting trade. I think it's the more interesting story here, because if we don't get to a place where there is confidence about the strait and we're hitting inventory tank bottoms, and Chris Wright said either way, he kept saying this, either way ships are getting through. That doesn't tell me there's like a solidified deal, right? This is a point where we have a higher risk premium, right? We are looking for alternatives out of the Middle East to get barrels. There's probably a bigger pull on US barrels because I want to have that secure kind of barrel without a lot of risk premium built in. So I think the long end of the curve, and I see 27 and even 28 when the market's expecting a lot of oversupply, as maybe something that does look interesting should things not come to a nice resolution in this next several months, and we kind of have the strait in a situation where we don't have full freedom of navigation. And I think that's the thing I'm looking at. So I think the long-term opportunities, you see the curve sub 70, are where it looks pretty enticing for U.S. producers and just on the crude strip itself. So that's my pitch on long-term.
And Julie, let me jump back on one of the clear thing that the market made a decision about in the short term. Of course, I think about a better answer after I've already answered. The better way to think about the short term is the market decided it was going to use its insurance. I'm going to draw down on inventories. I'm going to draw down on SPRs. China said, we're not going to keep importing. We'll draw down on our inventories. That is a by definition, you cannot do that forever. And so the longer this conflict lasts, the less insurance you've got. The more you might need insurance, and you're not going to have it. That's I think the potential ripple here. May not come to play, but that's the decision, the trade-off that the market made.
You know, y'all are obviously. Oh, go ahead, Rebecca.
I was going to say that the market's getting more comfortable with less insurance, having not seen this spike, and I think that's something that I keep coming back to is. Every time we have these events, and whether it was Russia, Ukraine, or whether it's this event where we project in us who count barrels and model, say this is where we should be, it should be 150, and it doesn't come to fruition, there becomes this trading mentality where, well, really, do we need that insurance? Were we overinsured? And I clearly don't necessarily think that's the right solution, but from the market's perspective, I see some of that conversation happening, and I think that kind of keeps a little bit of the premium out of the prices, but I agree. We need some insurance, and we've drawn it down.
Insurance is always inexpensive or too expensive until your house burns down. Right? So
then you're glad you have it.
Yes, exactly.
In terms of what you're hearing, I'd like to know what your investors are saying to you in this uncertain time. But apparently, as you're both explaining it, people are getting more comfortable with less comfort the longer this goes.
Yeah, it's not quite the Maytag repairman, but it's close from an investor perspective around energy. A lot of early interest, and then all of the uncertainty pushed people to the sidelines. I don't know what this is going to do. The overwhelming consensus was when peace breaks out, and it will, prices will come back down, and that's going to be bad for either owning oil or owning energy equities. And So a lot of people, even the energy dedicated investors, have moved to the sidelines to say, I will wait for more clarity. And so that's happening at the same time that technology's going nuts. And so you're not being paid to pay any attention to energy as an investor right now. You're being paid to pay attention to tech. And so you have two things happening at once that has sort of said energy's not top of mind for most investors.
A little bit of a different take. I think I see kind of the investment community looking at energy equities a little bit more closely than they're looking at the day-to-day crude moves.
Agreed.
Realizing that they don't necessarily want to be holding that headline grenade that is likely going to explode in their hands, that they want to look at the long-term story and build positions in those equities. However, I will say this, this is a very deliberate and slow process. It's not like the flood of money that's going to be rushing into tech. There is an interest, but it's got a spark to it, and I think there's a long-term story, but it's not frenetic. It's very deliberate in looking at that really long time horizon. And the question, honestly, I get asked the most is, why is crude not higher, right? When we sit down with investors, it's my initial instinct, everyone would have thought, is why is crude not higher? And then we walk through the scenarios, and I think, again, it just reiterates that I want to be investing in the equities that are going to potentially benefit over this long-term play. I don't necessarily want to be trading the short term. And if we just look at how the short term is trading, you can understand why that's the bias.
Where do you feel the market has fully shifted at this point? When people are not paying attention to this, where are they really focusing on the market right now?
I mean, I think they're focused on tech and kind of the exciting, explosive growth opportunities that they see in other areas, right? And within energy, I think there is an interest outside of crude-related producers, right? If you look at the IPPs and you look at different opportunities, I do see that shift within energy as well. Like, hey, okay, I don't necessarily want to look at traditional energy, but I want to look at some of the different things that power the AI data centers, and how do I play that? So I think there's a shift and an excitement around that, and of course energy is a huge part of that story, and I think it'll continue to be very exciting. So that's where I see kind of the, hey, this is what I'm interested in. But again, I do think there's a subset of investors really focused on the long-term picture for energy in the US, and traditional energy.
We have a little bit of time to get to some of your questions. I want to start with this. I thought this was very interesting. Looking back at 2030, what is the most likely energy-related risk that today's executive teams are underestimating? That's a good one.
It is. That takes us away from the war and the near-term commodity price dynamics. I think the thing that potentially is being underestimated is that, this is a depletion business, and I think the companies have been focused on rejuvenating their runway, finding more places to go drill oil and gas wells. And my guess is if we get to 2030, you're going to have some folks that wish they would have spent more money over the last 5 years. And that will be, and I think investors are going to say, I wish the companies had spent more money. So to me, that's the biggest risk, is that you're going to drill too much of your inventory in the next 5 years.
Yeah, I think underinvestment, right now, if we look at globally how much is being spent in terms of, looking forward into the 2030s. Maybe it's not 2030, maybe it's 2035. But companies are being rewarded right now for tight balance sheets, not overproducing, not taking the bait on a price rip to bring back rigs quickly, right? That's everything that they're being rewarded for right now. But if we look down the road, is that going to benefit us and leave us with a gap? I think that is a really interesting question. When you look at the UAE, they've made the investments. They're bringing the barrels back. There are pockets of places, and we do have Venezuela, which is a potential, right? And so there's that factor as well. So I guess in 2030, I think they're going to wish they spent more money now, and I think they're going to also think about, being a little bit out on the risk profile where they've been playing it pretty close to the vest.
Considering growing AI usage and the resulting energy needs, is America truly secure when it comes to energy needs in the near future?
Well, this crisis shows us that the industry finds a way. My assessment would be that we cannot grow power as quickly as the world would like us to grow power. That may not be a bad thing. That may help us avoid some overcapacity down the road. So the answer is nobody's ever as energy secure. We're living that right now. You'd wish you had more in situations like this. But I think the U.S. is in as good a shape as anyone, and so it's the best house in a neighborhood that's okay. So I think energy is fine. Not $50 fine, but it's fine.
So I think I would agree with that. I think if we look at how we've handled all the different situations, supply disruptions that have come up, we clearly have shown that the markets are resilient and we can respond. I do think it'll be interesting over the next several years if we can keep up with this demand. And I don't know if it's about the security of it, but it could be about the cost of it and how much of that we want to bear and who bears the cost of those energy needs, as well as the security. So I think there's two things at play, the cost of it and the security of it. They're both in question, but I'd say we are doing a good job of trying to meet those needs and getting creative, and I think we're more secure than maybe we think we are.
How important do you think energy security, messaging, and all of this becomes with the midterm elections ahead?
Everybody loves to think about the political angle of everything. I think it's tried and true that gasoline prices during elections influence voter behavior. And so the question is there anything anybody can do between now and November? And maybe there is, maybe there isn't. I think consensus says Republicans lose the House. So I think it's on the top of people's minds. I just don't know that it truly matters that much day-to-day energy fundamentals. I just don't think it does.
And investor-wise as well.
I think it matters in terms of the narrative. It's a huge part of the narrative. It comes up in almost every, press release that we talk about. Cost of living, energy prices is folded into that. So I think it builds into sentiment. Dan's talking about it. Does it change fundamentals? No. Does it change sentiment, though? And I think what we're learning over the course of these conflicts is that sentiment in crude markets, it's a paper and a physical markets, sentiment can be just as powerful as fundamentals. And I do think it plays a role in that, and I think that's why it matters.
Really appreciate both of your time today. Thank you so much. I hope you all enjoyed the conversation.